Hi everybody, I'm Steve McDonald and this is your midweek market update for the Investors Daily Edge. Well, the volatility in the market that I talked about last week is just getting worse and worse. There are an increasing number of factors that could drive us down. And if that car bomb in Manhattan had exploded, we'd be looking at a very different market today. Up 140 on Monday, down 150 last Monday, down 250 Tuesday. Lots of things driving this. But one of the better explanations I've heard lately is that many of the tailwinds that we've had driving us since last spring are turning into headwinds. It means it's going to be more difficult. The weak euro, oil prices, which have worked well for us on a play, but they take their toll on growth. Stimulus is nearing the end, and the housing stimulus is almost over. We have some good economic numbers, but there are so many crosswinds, the word is caution. Add to this situation the uncertainty of what the real effect of the new banking and investment regulations will be, as well as energy issues, and we have a lot of uncertainty that will only drive volatility higher. The answer, Sound Profits has been talking about the answer since its day one. Trailing stops, short-term profits, and rebuying when the drop in price levels off. The 20-60-20 rule. That means that we let the speculators take the first 20%, we take the lion's share, and we let the Johnny-come-latelys take the rest. And stock trends that work. Dividends, discounts, and big cap reliability. These things all work. These are the tools that make money in all types of markets, but especially in this one. An interesting note, U.S. small cap stocks have outperformed China's small caps since last year, and we've seen lots of movement in the small cap indexes recently. Now, I'm not much of a small cap guy. There's too much risk in it for me. They fall into that area that I call too many losers per winners, and that's too expensive. This whole scenario of a choppy stock market in the previous few years that were essentially a disaster for the little guy leads us to our topic for today. Most average and small investors, as well as a good percentage of large investors, are keeping their distance from the stock market. The shock of watching a large percentage of their retirements and savings just disappear has driven mountains of cash to the safety of money markets and savings accounts. The problem is that these accounts are paying almost nothing, and after taxes and inflation, remember these are all taxable, you actually lose money. With that in mind, I've asked the investment director and editor of Investors Daily Edge, Bob Irish, who has almost 30 years in the markets, to be with us to talk about alternatives to these losing plays. Welcome, Bob.
Steve, great to be here.
Thanks so much for taking the time. Well, you can't blame most folks for staying out of the market. I mean, that was a big scare in 2007, 2008. What do you think?
Oh, and how? I mean, the market in 2008 was off almost 40%. 2007, it was up a little bit. But, this decade's been a tough decade. It was bookended with two bear markets. Let's not forget 2000, 2001, 2002. The market was negative 3 years in a row. Right, and the 10-year number, of course, is negative, as everyone knows. So, no, I can't blame folks for not wanting to get into this market at all.
Now, what do you see out there right now that the average guy can do, other than money markets and savings accounts, that will make enough money that they can put some in their pocket after they pay their taxes and inflation takes its bite? I mean, what's available?
Well, Steve, you're right on when I look at that $3 trillion sitting in money markets and those countless dollars sitting in short-term CDs, I am dumbfounded, because clearly when you take into account taxes and inflation, people are losing money, just losing big money. I like bonds in this market. I really like fixed income.
Okay. Any in particular?
Well, Steve, I'm a big believer in the corporate sector. I think the government bonds are, well, the yields are a joke. You have to go out over, I think, 3 years to get up to 2%. If you buy a 30-year treasury, you don't even get 5%. So you have to stay away from governments. They're just too rich right now. I think corporates are the way to go.
And when you say government, you mean treasury bonds and bills?
Yeah, treasuries is what I'm talking about.
Okay.
Exactly.
Well, if we're talking about bonds, one of the concerns most people have is that you get out there so far, you get out there 10, 15, 20 years of maturities, inflation's a real issue. How do you deal with it?
Steve, you've got to keep your maturity short. I couldn't agree with you more. You go out long, you're asking for trouble. The way our government's been spending money, we are looking at inflation down the road, no question about it. So I'm thinking if you keep maturities in the, 3 years or thereabouts, I think you're in. You can get a very decent return and not have to worry about that inflation problem.
Okay. What kind of risk have you personally seen? And what I'm asking you to do is kind of compare the long-term risk of stocks to bonds.
Well, I mean, it's just been, let's take a look at the last 20 years, for example. The last 20 years, you did almost as well in a portfolio 50% stocks and 50% bonds as you did in a 100% equity portfolio. Think about that. Almost as well. And you got much more stability in your portfolio. There wasn't that roller coaster ride that people experienced in equities. So bonds are a stabilizing influence, and for crying out loud, over the last 20 years, they've done almost as well as equities.
Yeah, I mean, when you consider the last time I read some numbers in the journal, stock prices now, even with the big run-up we've had, are at 1998 levels.
There you go.
Yeah.
I just think that equities, the risk premium that we all thought was our birthright, I think is out the window. And actually, if you look over longer periods of time, I'm talking about a couple of hundred years, there have been many periods in history where bonds have actually outperformed equities. I think we all grew up with the Ibbotson chart from 1926 forward, thinking equities were the only place to be. Well, fact is, equities aren't the only place to be.
Yeah. As I said last week, the main theme of this market for the small investor is just don't make me any poorer. Bonds are one way to make a very good return without the risk of the stock market. Thanks, Bob, for being with us today. I appreciate your time.
Thanks, Steve. I appreciate it. We'll talk to you soon.
And there's no time, I'm sorry for the slap in the face award this week, but I'll have one for you on Friday. And we'll see you then. Thanks so much for being a part of us.